When most investors think about AI, they think about NVIDIA, Microsoft, or software platforms. But very few people ask a simpler question. Where does all this compute actually live, and how does it stay online? That's where Vertiv comes in. Before we go any further, let's talk numbers and price targets because that's what most people want answered up front. Vertiv is currently trading around $320 per share. In a base case scenario, where AI-driven data center spending continues growing at a healthy pace, and Vertiv executes in line with expectations, I see Vertiv trading in the $360 to $400 range over the next 12 to 18 months. In a bull case scenario, where AI deployment accelerates faster than expected, hyperscalers keep aggressively expanding capacity, and Vertiv continues gaining share in high-density cooling and power infrastructure. I think Vertiv can justify a valuation in the $450 to $480 range. In a bear case scenario where the broader market derates growth stocks or hyperscaler capex pauses temporarily, Vertiv could pull back into the $260 to $280 range without breaking the long-term thesis. So this is not a no-risk stock, but it is a stock with asymmetric upside if AI infrastructure spending remains strong. Now let's talk about what Vertiv actually does, because this is where the story gets misunderstood. Vertiv builds the physical infrastructure that data centers cannot operate without: power distribution, thermal management, cooling systems, backup power, monitoring, and management tools. They don't sell optional upgrades. They sell mission-critical systems. If Vertiv's equipment fails, servers go offline. AI workloads fail. Cloud services crash. Customers lose money. Now here's the key point most people miss. AI data centers are completely different beasts from traditional data centers. They consume vastly more power. They generate significantly more heat. And they require much more advanced cooling and electrical systems to function safely and efficiently. Traditional air cooling is often not enough anymore. That's why liquid cooling, high-density power delivery, and thermal optimization have become central to data center design. And Vertiv has been investing in these exact areas for years. This isn't speculation. This is happening right now. As NVIDIA, AMD, and others roll out more powerful accelerators, racks get denser, temperatures rise, and infrastructure becomes the bottleneck. Vertiv doesn't care which chip wins. They benefit regardless. Every increase in compute intensity increases demand for Vertiv's solutions. Another reason Vertiv is attractive is its customer base. Vertiv sells to hyperscalers, colocation providers, telecom companies, large enterprises, and government customers. These are not impulse buyers. Once Vertiv's systems are installed in a data center, they tend to stay there for years. Switching costs are high, replacement cycles are long, and reliability matters more than price. That creates stickiness. On top of hardware sales, Vertiv generates recurring revenue through maintenance, monitoring, upgrades, and lifecycle services. This turns a historically industrial hardware business into something closer to an infrastructure platform. Now let's address something important: margins. For years, Vertiv was viewed as a low-margin industrial company. That view is outdated. Management has improved operational efficiency, focused on higher-value solutions, and benefited from massive demand tailwinds. Margins have expanded meaningfully, and management has indicated there is still room to improve. Margin expansion is incredibly powerful because it allows earnings to grow faster than revenue. You don't need explosive top-line growth when margins are moving in the right direction. Now zoom out and think about the bigger picture. AI deployment is still early. Companies are still figuring out how to integrate AI into workflows. Governments and utilities are struggling to keep up with data center power demand. Grid constraints are becoming a real problem. That puts even more pressure on efficient, reliable, and optimized infrastructure. Vertiv sits at the intersection of all of that. They're not selling hype. They're selling solutions to real physical bottlenecks. Now, let's talk about valuation risk, because this is where people get uncomfortable. Vertiv has already had a massive run. There's no denying that. Strong stocks often look expensive before they get more expensive, but that doesn't mean you blindly chase them. At these levels, Vertiv will be volatile. If earnings expectations slip even a little, the stock could pull back sharply. You should expect that. But volatility is not the same as broken fundamentals. As long as data center spending remains strong, AI workloads keep scaling, and Vertiv keeps executing, the long-term thesis remains intact. Another thing working in Vertiv's favor is backlog and visibility. Hyperscalers don't flip spending on and off overnight. Large infrastructure projects are planned years in advance. That gives Vertiv more visibility than many other industrial companies. Even if the economy slows, AI and cloud infrastructure spending is not something companies can simply pause without falling behind. Now let's balance this with risks. Customer concentration is real. A meaningful portion of revenue comes from large hyperscalers. If several of them pulled back at once, Vertiv would feel it. Competition is real. Schneider Electric, Eaton, and others are well capitalized and aggressive. Vertiv must continue innovating, and valuation sensitivity is real. This stock will not move in a straight line. But here's the counter-argument. Vertiv has transitioned from being an overlooked industrial supplier to being recognized as a core AI infrastructure company. That perception shift matters. Institutions are no longer modeling Vertiv like a cyclical industrial. They're modeling it as a growth-at-scale infrastructure business tied to one of the largest secular trends of this decade. And importantly, Vertiv does not rely on AI hype to survive. Even without AI, cloud migration, data growth, edge computing, and digital transformation support long-term demand. AI simply accelerates everything. So how do I think about owning this stock? Vertiv makes sense as a long-term AI infrastructure holding. It also makes sense as a stock to add on volatility rather than chase aggressively. If you already own it, the key question is whether earnings continue to grow and margins hold. So far, they have. If you don't own it, patience matters. Large pullbacks are likely to be better opportunities than Green Day breakouts. To wrap it all up, Vertiv is powering the AI era from behind the scenes. They operate in a mission-critical space with high switching costs. AI is making their solutions more valuable, not less. Margins are expanding. Backlog is strong. Demand visibility is better than most industrial companies. This is not a speculative trade. This is an infrastructure compounder. And as long as the world keeps building data centers and pushing compute limits higher, Vertiv will be there supplying the power and cooling that makes it all possible.